need to be there as well, so that when we face uncertain times like today, we always have some, items to fall back on and, to tide us through our investment journey as well. Yeah.
Absolutely. Important points there. What is not necessarily sexy might be actually the best for the long-term strategy of things. And that's what we're looking at. And it's become more apparent with the volatility that we're faced with. And it's not just volatility, it's uncertainty. And so I think a lot of the questions the past few days, we've had recurring themes, and I highlighted it just now. We can definitely go into it for our fireside chat. But perhaps maybe tell me a little bit about yourself, Darius, and why they should be listening to the key insights for today.
Right. So first and foremost, I panic a little bit when you use the word expert. I wouldn't really call myself an expert because say what you like, for as long as we've been in the industry, which I have been, very fortunate to be part of, over the good 17, 18 years. I won't say that I know everything that happened in the market, but
Mhm.
enough to see, certain market events happening, right? So 2004 SARS, 2008 global financial crisis, were fortunate enough to ride the whole Asian wave up and, to see things correct and crash as well. But
Mhm.
what's very nice is obviously, working for an organization like Nikko Asset Management. I have many, many teams of fund managers, economists, strategists, and these are the people which I pull ideas from, have conversations day to day, and they are the ones that lead me to what we're going to discuss today. So it's a collective bunch of wisdom, and so it's the experts behind me that help me to sound good today. I will say, yeah.
Yeah, I love that, Darius. Now, that collective perspective, I think that is something important because in the past shows that we've had with you, we started with future mobility and then we went into market outlook, and now we're going into integration of world of sustainable businesses. Now, before you begin sharing your insights, maybe let's unpack the title a little bit further. All right. So it's about integration, right? So it's probably, putting that into your current strategy and trying to integrate proposed solutions you're about to have. But a bit further on the sustainable businesses front, would you say it's more related to quality and also figuring out what else you can have in the long-term investment goals?
Thanks. I think that keyword is very, very practical today, and that's the quality word that you use, right? Because I think, especially in the run-up of things in the last 2 to 3 years, people got caught up with the whole excitement of what's hype, what's new, what's trendy, what's more fun. They forget to look at, really what's the quality of the businesses behind what they were investing. And so I think, not trying to pour, water on any form of investment and all that, but given where, you hear all these scandals with, FTX and all these others in recent days, I'm sure some people are now scratching their heads, asking themselves, where was that quality? Where was that fundamentals in all these things that we were looking at? And so while, obviously we've been spooked a little bit in the last 3 years, especially with FOMO, fear of missing out and all that,
Of
with
course.
regards to
Yes.
tech stocks rallying and all that, now everyone's really taking a step back and saying, hey, what was the value of that? Where could we have, perhaps noticed some stop signs, some warning signs, and then, change the strategy and all. So I think quality is something that is very, very key. Not very, very fun to look at, but at the end of the day, I like to hearken it to a bit of a mattress as an analogy, right? Say what you like, a trampoline is more fun to play and bounce on. But when you're trying to get a good night's sleep, you don't sleep on a trampoline, right? You still sleep on a nice little mattress, a quality one with spring support, etc., etc. So likewise, trying to put some of all these things back into, your investment portfolio is great to be able to tell a story to your friends. Hey, I bought this thing, it went up 100% and all that. But I think it's something else altogether, to be a seasoned investor and
Right.
go out and tell your friends, look, sorry, I bought the boring 5-7%, but it's made me 5-7% in the last 10 years, and I think that
Absolutely.
that's really a question of, for the listeners today, which angle are they coming from? Nothing wrong with a trampoline. Everyone likes a good bounce once in a while. But are you really here looking for that kick, which I hope we can offer up some ideas as well? Or are we looking for, something that gives us a bit more sound sleep and, ride out through this particular volatility? Yeah.
Thanks
Mm,
for setting the stage there. I did a panel in a few weeks ago about like the FOMOs, the fakers and the free riders, everyone who's just jumping on the bandwagon related to investment trends. And so, they're paying the price for it right now. So I'm really excited to see what you're about to share for that long-term strategy and goals. So without further ado, the floor is yours, Darius.
Thanks, Olivia. So if I may, just trouble Camille, to bring us to our next slide. I think I'll start off with a very quick 3 pointers about what's happening in the world today. So first and foremost, I guess, this is not new to every one of us. We started out with this slide, talking about Russian-Ukraine conflict, and obviously, why I wanted to paint this picture while the year 2022 is about to be done and dusted with. I just want to take us back about a year ago. Probably, let's say we were in 1st of December 2021 instead of 2022 now, and we were looking at what's going to be the year ahead. All of us were hoping, after 2 weeks of Christmas, insufficient alcohol to, kill every germ in our body of virus and all that, we'll come into 2022 full of hope, full of optimism, only for that to be really rocked by this conflict that started. And of course, throughout 2022, we not only see pockets of that happening there, we saw certain tensions with China, Taiwan, etc., as well. But what this really has done is, on top of the current situations at the beginning of the year, which was still COVID measures and all that, it really led to a huge strain on the system from a point of your supply chain management issues, right? And obviously, earlier days we were talking about factory closures, etc. With the Ukraine-Russian conflict, it then added a new dimension of energy constraints, to the whole mix as well. And what essentially this has done is it threw inflation up. Obviously on the slides we're talking about high inflation in US, largely because in a while I'm going to talk about rising interest rates, but that's no stranger to all of us. Even Singaporeans, we all face it, right? You see enough newspaper articles to see how unhappy people are with their rising price of cai peng, a rise, economic rise, right, in the news. But truly, what that has done is, with the cost of inflation, or the cost of living because of inflation, the federal government has then said, look, we've got to come in, we've got to put stops in, and all these others. And we saw rising interest rate kick in really, really quick, especially with the foray of the last 5 to 6 months being at its steepest climb. And I say steepest climb because, again, separately from my life here at work, I sit on a couple of other boards and committees of social development committees and all, and I'm helping them with regards to fixed income kind of instruments, right? Fixed deposits. And it was only a year ago, Olivia, that fixed deposits was like less than 1%. Today, you're getting fixed deposits at 4%, right? And that's all due to the climb in the interest rate. And what this has really done is it's shocked everyone, thinking that recession is about to come in. Now, end of the day, I wanted to just point out on this slide, I mentioned something there about the China zero COVID policy, because I think what's really I'm trying to bring about to the world is that while the US has increased interest rate again and again and again, the interesting point is that, I wanted to flesh out to everyone that this inflation is really a supply-led inflation. It's not a demand-led inflation. And so with the demand-led inflation, your economic textbooks will tell you raise interest rate. That will solve all the problem. You will suck some liquidity out from all the spending, some of the investing back into the bank accounts. But in this particular instance, it's all about factories closing, COVID measures. We just can't get enough stuff produced fast enough to meet that demand. So the real question is, how much of an impact does rising interest rate actually have, with regards to curtailing this supply-led inflation? And so as a result, I'm leaning two ways here. One, obviously, the world gets back to normal, and that involves China also opening up, etc. And then the supply chain issues sort itself out. And then with that, we will start to see probably our big brothers, the US, claiming the victory and slowing down the rate of rising interest rates. However, as we all been hearing, and you so rightly pointed out right at the beginning of the episode, if there's some fears about riots and all in China, which, kind of brings about point 0.5. And if, they are going to keep their very, very strict stance, and all it needs, right, is actually a whole round of cases to, trigger in China. And I mean, as Singaporeans, we all know with the last variant, it's very, very contagious. So let's say China does get a couple more cases and they want to really default back to this. What you will see is them tightening. And then guess what? We'll be back to supply-led problems again. We'll go back to point number two, higher inflation. They will continue to raise rates, more risk of recession, so on and so forth. So I think this is really in a nutshell, if you need to kind of like summarize what's happening or what potentially could happen and the worries, this is the 5 points that I wanted to just bring out. It could reoccur. On the next slide, I just want to focus a little bit more then about in Asia, because again, as I ended off with, the elephant in the room on the first slide being China, when you look at investing in Asia, we cannot say that, we're led by Singapore, Hong Kong anymore. The real elephant in the room is people like China, India, so on and so forth. And over here, I think following the 20th Party Congress meeting, it's very, very clear what China's stance is going to be, and, for that matter, I wanted to just say they are adopting a very much more open economy. They're trying to, do things that's very, very different from the Western counterparts. And, what's one of the first few things that they're trying to be very, very different about? Interest rates, right? So while the US is hiking interest rates, China is actually cutting interest rates. So this again also means different things for bond investors, for example. So if you're looking at as an Asian bond investor, you could look at China, for example. Now, there's always going to be that worry that, a hawkish federal government will always then weigh very heavily against the Chinese equity market. But who's to say then that you can't invest in the bond market to get some returns, right? So I just wanted to throw that out there as well, because I think, the common thing, a common wisdom that we like to say about investing is don't chase the herd, right? Earlier on, you talk about all the FOMOs, the fakers and all that. That's exactly what happens. If you're jumping on that bandwagon, then you're doing exactly the same trade as everyone. You got to start thinking a little bit contrarian. And I'll borrow that saying from Warren Buffett, be greedy when everyone's fearful and be fearful when everyone's greedy. But last but not least, again, I think we have to anticipate that even if we're looking very, very bullishly at China, China itself is not going to be China 10 years ago. And by saying that, I'm saying that, they're not going to do 10% GDP anymore, 15% GDP. If anything, I've been hearing more and more comments, it's looking like a 3% GDP growth next year for China. And so investors of our vintage, or maybe even vintages older than us, has been used to China operating at a very high octane. So now you've got to dial down your expectations in terms of that growth number. But what this means is that look really clearly at the quality, that you brought out. Because just because the Chinese economy is growing at only 3%, it doesn't mean that Chinese companies are growing at 3%. Some of them are actually growing leaps and bounds. Some of them are doing very, very well with regards to just domestic consumption and all that. So that in itself will lead on to potentially trigger, and knock-on effects to places like Malaysia, places like Thailand, places like Indonesia, and obviously Singapore being a very, very open economy as well. That is potentially a knock-on effect as well. So on my last slide, just purely in terms of this outlook segment that I would like to talk about. So if Camille can help me to forward to the next slide, I want to just really say where the risk, and obviously in programs before, so not to bore the repeat listeners, I'm not going to highlight every single thing, but clearly two things I wanted to just very strongly distinguish over here. I think that with regards to risk in companies, that has been an oversold story, and I say that with all due respect, because when I look at many of the companies today, they are all doing the right stuff. And by the right stuff, they are not over leveraging, they are not overstretching their P&Ls, their operations, so on and so forth. They are all being very cautious at this point in time as well, because they know there are tough times ahead. So when you look at some of the names though, given the quality of the companies, given the their blue chip names, so on and so forth, for their share price to take that much of a hammering, to take that much of a drop, signals that there could be potential for people to actually go in, grab some of all these and sit on them for, some periods of time and get some returns. So the one thing, if any, I want to give you all some comfort, especially if you're investing in mutual funds and all these others, is that companies are not all that bad. There will be some bad eggs. I mean, like Chinese property segments, for example, or even some consumer names and all these other things. And it's a case where winner takes most, right? But there is always going to be a segment of it that will do well. So back to our definition of sustainable, and then, they'll be able to flourish in the next 1 year, 3 years, 5 years. So where are the real risk? And I don't know whether I'm going to be echoing something that your former panelists and audience, and speakers have said before, but in our opinion, the real risk today is something that we have not experienced in maybe the last 10 to 20 years, and that is really coming from all the political risk. And political risk really because, these days we're seeing, people being so upset that governments are being refreshed every other few years, few months. I mean, we've just seen how UK changed prime minister after 45 days, something very unprecedented. You see even in Malaysia, our next door neighbors, something that's never happened before, where you had a gridlock election. So first things first, I would say that, a lot of places right now, the political scene is very, very polarized. And as a result, the governments of the day could be trying to make some kind of reforms, some kind of measures, but because every decision now is polarized by which political party you're supporting, that could actually hinder and hamper governments from effectively creating policies that will benefit the market and i.e. benefit the companies that we're trying to invest in as well. But secondly, I think what's also interesting is that when you look at certain countries and you hear of stuff like, oh, they're putting too much restrictions, too much curbs. And I think one that obviously comes to mind is China, again, because of all their tight regulations around social media companies, IT companies, and all these others. And last year we saw when some of those signs and signals happened, the market reacted very, very strongly against all these tech giants as well, but only for them to later on rebound. And I have a particular, favorite antidote to use in this, and that was gaming, right? So, when you talk about gaming last year, they wanted to make sure, you don't have that much of a brain rot, brain drain in China. So they put a law in to say you can't play that much computer games, etc., in China anymore. And what happened was the share price for Tencent fell. Everyone says, oh, that's it, that's the end of gaming, right? But what has happened since then? Tencent has launched new games, and people have drove, in throngs to play that game. People are spending money still in that game, and the next thing you see, Tencent has a bit of an uptake because of that. So, Olivia, I've been sharing with people who's to say, in 1 year's time, 3 years' time, 5 years' time, if you really do a side-by-side comparison, who's to say that these Chinese companies, because of the things that they've gone through, they are not more socially responsible, but yet, check the box of being profitable, doing all the right things, vis-a-vis their Western counterparts like, EA Sports, Activision, just to name a couple of all these guys. So I think this is a very interesting dimension because while it could be a couple of negative news with regards to the actions of the day, but you're looking at something that has a lasting impact. And obviously, companies are beyond just one aspect of their businesses. They evolve, they change as well. Last one that I would just want to throw it out there is if you look at all the energy companies of the day, right? Today they know the world wants to go green, but the likes of your Shell, BP, ExxonMobil, and all these other guys, what are they doing? They know that they are dirty, so to speak. So they have to go into the green energy segment, rechargeable segment, and they're trying to, change the way that they operate, which really just cements what I'm trying to say over here. Companies are doing well. They're doing all they need to do to survive the volatility, the market situations, and what's happening. But it's really the curveball is going to be what the governments of the days are going to be throwing at them. So that's the potential risk. And in my opinion, then is again back to picking the companies that have good track records of doing what's right and being able to be sustainable in the long term. Yeah. So with that, I mean, I'm happy to also just share one last slide with everybody. So if Camille can help me on to the next slide. I see a couple of potential opportunities here as well. While this is a bit of a shameless shout out and plug into some of the products that my firm has to offer, if you ignore the fun names, it's all right. I'm happy with that. But just pay attention to some of the boxes that I'm trying to throw out as potential ideas as well. So the first things first, number one, two, and three requires the listener right now to have a little bit more of an equity appetite and equity overweight. Why? Because, with equity markets being beaten down so much, if your investment horizon is 3 years, 5 years, 10 years out, and really because you could be investing for, retirement, children's education, so on and so forth, you do have that horizon. You're not worried about entirely about what's going to happen in 2023, 2024, and with that, then you can take a bit more of an equity overweight exposure. So what you should be looking at though is if you're really conservative, go into the more defensive income equity like. So over there, we have things like Singapore dividend, Japan dividend, but again, ignoring the markets and all that is really what we call the dividend play. So you can get into some blue chip companies, sit tight, take the income, take the dividends, and be happy with that 5%. Because even as markets take a bit of a beating, you know that with all these blue chip companies that can pay dividends, they're going to rebound at some point in time down the future. The next one, number two and three requires you to be a little bit more like myself. When I say myself, is because I have very young children, so I have an extremely long investment horizon. My youngest is 2 months old, so I've got 20 years to go, right? So with that, my portfolio can be overloaded with things like growth, tactical opportunities as well. And by growth, I mean I'm looking more at global equities where there are a lot more things beyond the realm of tech. And so in our global equity funds, for example, we don't buy into a lot of the Apples, the Yahoos, Amazon, and all. We find opportunities in other segments. So if you still like all these, we call it the sexy, the fun names, you buy them as your own, but you need something as a complementary. This is what you can look for. Products that are complementary to what you're already invested in. But at the same time, there are things like, Asia, which is very, very underinvested in the last 3 years. And if you're looking more at the tactical, even Asia as a small cap. So our Shandon Emerging Enterprise, for example, that's a small cap kind of a play, right? And when you look at the small cap, there are a lot of names that are very distinguished away from your Tencent, Alibaba, and all these other firms as well. And those will be the companies, especially when you're coming out from a deep fall, they will be the ones that come out and rebound faster compared to some of their blue chip counterparts as well. And then obviously, if you still have some appetite for innovation, disruption, and you've not been invested in any of that in the last 2 years, good for you. This is really a good time though now to pick up some of all these on the cheap, and then again position that for your next 3, 5, 10 years to come. But obviously, Olivia, not all of us can be just equity focused and all. So some clients in the room today, they are still also, perhaps reaching the time frame where they will need to expense some of their hard-earned money, some of their hard-invested money, and then they would need to park it into some safe instruments like fixed income and all. And I think fixed income, if you have not been invested in it in the last few months or 1 year or so, congratulations, because as interest rate went up, you avoided the whole fall in fixed income space. Now is a good time to consider coming in, because at any one point in time, some of all these products that used to yield something like 3%, 4% could now be looking at 5, 6%. So that complements as well, that income story that I was talking about earlier on, where you're not trying to pick a side, you're just trying to protect capital, take home a little bit more money while you ride out all this volatility. So Shandon Income, Dynamic Bond does all of that. But if you're obviously one of those that feels the federal government is still sneaky, they're going to continue raising interest rates, you want to avoid that fall, then a short-term instrument like our short-term bond fund will help you do that, because right now our duration is less than 1 year. So what that means is that if interest rate goes up 1%, our fund falls less than 1%, but you're getting a 4, 5% pickup in terms of a yield story. But obviously, when we started out, we wanted to qualify sustainable, right? So now we're going to throw in a curveball here. While we don't talk about sustainability from an ESG perspective and all that, if you want to consider that, there is also a lot of instruments out there beyond our own offering as well, where we have the impact investing sustainable, impact investing multi-asset fund. You could consider some of that. Again, only talking about this really because when you want to invest into sustainability, ESG, and all that, you're looking at the next 1 year, 3 years, 5 years, even 10 years kind of a time frame, really, because this segment needs that time to grow and mature. And even as green bonds and all these things start coming about, it's not an instant fix. Even the Singapore government has only been issuing it for like the last couple of months or years, 1 year max, right? So all these things are a developing asset class. But if you are trying to put some of your hard-earned, hard invested invested money towards the future as well for your children, your grandchildren, then all these things are become very, very important. And that could be another point of consideration as well. So right now, I'm just going to leave that as that for this point in time. Happy to, come back to the table and have a bit more discussions with you, Olivia. Yeah.
Excellent, Darius. So with that, thank you once again for your insights. And the audience is already asking quite a lot of questions related to what you just shared. So, let's start off with just a quick chat between the two of us, because I've
Yep.
got some follow-up questions from what you shared. So for our, investors in Singapore, and especially the ones that, look at the Singapore market, what is your outlook with that? Because I think you touched on it a little bit, but maybe you
Yeah.
could expand a bit further, Darius.
Yeah, sure. I think the interesting thing about Singapore market and our home market is that when things get fun, things get exciting, all of us exit Singapore. It's kind of like this upcoming December period, right? When we have holidays. Who's thinking of a staycation? Nobody. We've done enough of that for the last 2 years. We want to go Japan. We want to go elsewhere. But I have one slide that I think if I can trouble Camille again just to put it up, it will kind of show you how Singapore has performed in the last few months and perhaps up to a year.
Mhm.
Yeah, uh, s- Camille, if you don't mind, can I have the next slide? So what this will really show, is everything else is down, the S&P 500, the world index, etc., etc. And hey, look at the bright red, or the little red dot. We're hanging on and we're hanging on well. So I think what we can always say is, and again, I hate to sound like a broken record, but borrowing that one really nice word that you use, quality. I think say what you like, a lot of Singapore companies are quality companies. We may not feel it, maybe because we're working for one of them or something. But when you look at the banks, when you look at our telco companies and all, we are world class, to be very, very honest. I mean, many times DBS, OCBC and all have been voted world's best bank, world's most innovative banks and all. So during periods like 2022 and potentially 2023, where things get a little bit more volatile, you still want to fall back onto all of these steady Eddie guys. And not to forget, because, with the Singapore market as a whole, today the banks, quite kind of represent almost half of the STI index. And why so? Because rightly in a rising interest rate environment, who's going to make more money? It is the banks because of their loan, interest income, so on and so forth. But other than that, a big component about Singapore as well is with regards to our REITs markets. And so for those listeners right now who have a lot of experience investing in REITs as well, you would have had the days where, the last 2 years, REITs has kind of like taken a beating. It came down from the good old days of 7-8% down to about 4.5%. But right now, with this whole rising interest rate environment as well, REITs have all started to climb back up towards the 5-6% mark. And so this again further strengthens the fact that, look, while you're not going to get anything fun and exciting, you are definitely going to get you something that's a little bit more defensive, a little bit more profitable. And again, with the rest of the basket of Singapore companies, you are talking about companies that are not just invested in Singapore per se. And one company, I mean, not to highlight this company to give it more airtime and fame and fortune, but I always like to use this analogy of bread talk, right? So we all think about bread talk as, oh, toast box. I mean, and you might be thinking to yourself, well, how much bread and toast, we all love our toast, but how much bread and toast can 5 million people on one red dot consume? But when you look at companies like Bread Talk and all, they don't just invest in Singapore. They have outlets in, KLCC, China. They have rights to like Carl's Jr. and many other restaurants and eateries. So when you're looking at a company like that, it is regional, number one, and there are more franchise names that we actually think about straight off the fly. And that again enhances the exposure that you get when you're investing in some of these Singapore names. It's not just a Singapore story. There are other areas that they are invested in and operating. Obviously, if I go to the other extreme, there's Singtel, right, with Optus in Australia, etc., etc. So again, hate to sound like a broken record, but we are defensive. We are well exposed to regional growth and regional, income streams as well. Yeah. So that's what I like about the Singapore story. Mm.
Right. And stability is also a key factor, in the
Yep.
past 12 months at least, that has recurred. And they've talked about how resilient the Singapore market, in fact, is. So,
Yes.
thank you for broadening the perspective there a little bit.
Yep.
and also demystifying a lot of the conceptions right now related to the Singapore market. Thank you
Yeah,
for that.
no
Next
problem.
question I have for you is, of course, the rising rates topic. So, with the rising rates environment, we've got interest rates and inflation. So, how will your funds be impacted by this?
Mm. I would say broadly, given the couple of boxes that I showed just now,
Mhm,
so first and foremost, whenever rates go up, I think everyone straight away thinks about, oh, what's gonna happen to my fixed income fund, right? And
mhm,
earlier on, I talked about, the short term. So again, I'm sure there's pockets of listeners here who are very well versed with, investing in fixed income, but maybe a little bit for the uninitiated. I think beyond looking at the obvious inverse relationship where interest rate goes up, bond prices go down, a lot of times a lot of people don't understand that the quantum in which the fixed income instrument falls is because of duration. So just to help everyone, I mean, if you're talking about 10-year bond, right? So when interest rate goes up by 1%, you need to multiply by 10, the 10 years, and then you will face a corresponding 10% drop in your NAV, or your $1 goes to 90 cents.
mhm,
Similarly, if it goes down 1%, then you get a 10% increase. So earlier on, I mentioned about guys who may need their monies in the next 1 year, next 2 years, and they are not willing to take the chance while, earning 5, 6% in the equity market sounds exciting. They don't want another 10, 20% drop. Then they need to park it away into fixed income. Yes, short-term instruments will be very, very useful because, especially like with our short-term bond fund, when the interest rate, if it goes up 1%, it's going to go down by zero point 0.9 because our current duration is about zero point 0.9, right? So less than a year. But what it does mean though is that, with our current yield, we're looking at about those the flips. Sorry, can y'all hear me? Hello? Hello?
Hi, we lost you there for a second.
Oh,
So just
okay.
wrapping up on the how the funds will be impacted.
Yeah, sorry. So I'm not sure where you lost me off, but say we're talking about needing fixed income. I was
Mhm,
talking about still you would then want to hide away in short-term
mhm,
bonds. But of
mhm,
course, if you are willing to stomach that little bit of losses in fixed income for 3 years, 5 years, and all, then it's still a good idea. But of course, with the rest of the pockets of squares that I showed to you earlier, so again, maybe if Camille can go back up one slide to end off on the 5 boxes, then people can visualize it a little bit more. I think there will be lower impact if interest rate continues to hike in terms of the more defensive kind of a names. So if you're talking about stocks and shares like in Singapore dividend, Japan dividend, right? That will be a little bit more insulated because it's already what's happened. The interest rate has hiked and you can see Singapore market has been resilient, so on and so forth. Where I would envisage a little bit more impact is towards the growth and the tactical kind of names, because whenever there's recessionary fears and worries, then these will be the pockets of spaces that will tend to wobble a little bit more. But yet at the same time, I mean, while I say that, these asset classes have already given away a lot, a lot. I mean, some of them are now, I mean, for growth and for tactical, they are still expensive in the sense that they are above the 15 times price earning kind of point. So some are at 17, 18, 20 times. But, when you're looking back at historical, corrections, recessions and all that, there is still an argument to be made that they are cheap respective to the historicals, so on and so forth. So again, they will be a little bit more impacted, but is there a lot of room for them to crash even more? The answer will be no, because then they will be going towards 15 times, 13 times, right? And that will be almost bargain or 2008 kind of levels. And it doesn't just feel like 2008 at the moment. That's all.
mhm.
That's all I can say. Yeah. Mm,
Right. So with current market situation, and to contextualize it with the recent events that happened, does investing
yeah,
in bond funds still make sense? How can we address the skepticism?
yeah.
Um, we have that skeptical investor out there listening to this.
Yeah, so I would say I like to classify into three buckets again. So first bucket is if you're skeptical but you're like myself, and you've got an extremely long investment horizon, then bonds just don't make sense for you. So as a result, I don't have any bond allocation in my portfolio, Olivia, because I think my children are young. I can take that that volatility that the equity market has to offer, and I am cognizant that I have to throw away my emotions. So if things
Mhm.
dip further, that should be more of my buying opportunity, right? So there's one group that I'll say if you are like me, then don't go into the bond market. But with those that need to go into the bond market, then there's clearly two groups of you. One, the ones that need money in the short term, then I would say yes. Short-term bond fund, don't get exposed, don't get caught out by the equity. Sorry, don't get caught out by the rising interest rate, and that further dampens your NAV returns, but then clip that coupon along the way as well. But
Mhm.
those that are really more looking at fixed income because you are very risk adverse, you still are highly skeptical because you think that the equity market is going to give another 10, another 20%, then
Mhm.
yes, fixed income, if anything, especially in a year like this where, correlations has just been thrown out the window. I mean, in the past, equity goes up, bonds go down, and vice versa. This year, both have gone down together. But if you look at the quantum of the down, fixed income instruments have obviously been more resilient than the equity market. So if you are looking at that as your base story, so to speak, where I don't want to take that 10, 20% hit anymore in the equity market, then yes, parking it in the fixed income space, and then taking a small minor hit, 3, 5%, but yet clipping my coupons of 4, 5, 6%, maybe even I might make, flat for the year, or I might be slightly positive for the year. Yeah.
Thank you for sharing that. And last question, just to round up our fireside chat. You
Mm,
mentioned, Japan, right?
yep.
We talked about traveling as well. So with Japan finally opening up its borders, I mean,
Yeah.
finally, is it a good time to invest in Japan, for example?
Well, obviously, I'm going to be a bit biased because I work for a Japanese company, to say the least. But definitely, it is a good time to look at Japan for two very key reasons. One, I think, and thanks for bringing up the slide already. If you're looking at, the quality, again, I want to bring up this Q word, but if you're looking at the quality of Japanese equities and so on and so forth, Japan has been really overlooked by a lot of investors in the last 3 years. I mean, again, as things were running and things were going crazy, you have a couple of tech names in Japan, but then again, a lot of these tech names, right, they are a lot more, I would call them the support chain. So a lot of Japanese companies, they either make stuff that, the end product comes out with, and as a result, a lot of us are not familiar with Japanese names. I mean, at very best, we only know Pokemon Go. So as a result, we know Nintendo, we know the Sony, so on and so forth. But then again, looking at where PEs are today, looking at where dividend yield, and I specifically want to stress on the right hand side where you see dividend yield. Dividends has been always a very, very touchy subject in Japan, right? But for the first time in a very long time, you can actually see that the dividend yields in Japan are now stronger than that of the S&P 500. And obviously, because S&P 500, you're talking about a lot of tech companies which don't pay dividends in the first place. So what you're really looking at here is for people to have a bit of a switch in mindset that I want to go for a quality kind of a name, get all these Japanese companies, which are suppliers, by the way, to a lot of all these S&P 500 names. And then, yet at the same time, I clip a very nice coupon from them and, ride out this wave and all that. So I would say that Japan definitely fun, because of where they are right now in terms of pricing, in terms of dividend yield as well. Another interesting fun fact that I wanted to just talk about the Japanese market is while, somewhere a couple of months back, or was it couple of weeks back, obviously there was the assassination of Abe, and this guy has done a tremendous amount of work for Japan, and not a lot of credit has gone to him. But one of the things that he has done is really to spearhead corporate governance and try to, get all these big conglomerates to detach themselves, and focus a lot more on shareholder equity, shareholder return. So I would say 10, 12 years ago, it might shock many of the listeners, but up to 75% of Japanese companies were not profitable enough to pay corporate taxes. So
Mhm.
yes, your Toyota, Hondas, and all great, they were paying corporate tax, but 75% of all Japan companies were not. Today, because of all these corporate reforms, corporate change, implementation of independent board of directors, etc., a lot of all these Japanese companies have turned the businesses around. They're really focused on the quality, the shareholder interest, returning dividends, as you can see. And as a result, 75% of companies right now are profitable in Japan enough to pay taxes. So this is really a huge turnaround when you talk about, the corporate governance and the corporate culture and the stock market for Japan. So definitely a lot of interesting names I would encourage people to look at there. And obviously, we are biased in the sense because we know the market so well. We have Japanese growth, Japan value, and our Japan div that I was talking about. So we know many of the companies very, very well. So I hope that qualifies us to make the statements that I've said. Yeah.
Thank you so much for sharing that and also for giving us new perspectives. It's always about learning key insights from experts like yourself and us as the bridge and access to you guys. Now, we're going to do our first giveaway. And Darius, please stay on the line because I would like you to have the honor of answering the correct answer for this. All right. So we're going to do our first giveaway to the audience watching. Thank you for joining us. For those who just joined in, we're covering the world of sustainable businesses and how you can integrate that into your overall investment strategy. So today we're with Darius Fu, of course, Nikko AM, and we're about to do our first giveaway for today. First 5 people with the fastest fingers first. And of course, the right answer will walk away with something from our teams. So Darius, are you ready?
Yes, I'm good. I'm good.
Okay, so you'll give us the right answer, all right? I'll ask the question,
Definitely.
give us the answer. Okay, in 3, 2, 1. Which of the following is not a Nikko AM fund?
Am I supposed to tell it now or give
No,
them some time?
in a second, in a
In a
second.
second,
So
got you.
for those of you out there, please answer the right answer right now. You've only got this few seconds, all right? So is it A, Singapore Dividend Equity Fund, B, Shenton Short-Term Bond Fund, C, Japan Dividend Equity Fund, or D, Super Growth Fund? Which one is not a Nikko AM fund?
Shouldn't be too difficult. After all, I've been name dropping
Yes, I
everything.
hope you were listening. All right. Okay, looks like we've got our top 5 winners. Now, Darius, which was the right answer?
So D is not one of our fund. We should have made not a big word. So we don't have a super growth fund, but definitely Singapore dividend, Japan dividend, been extremely resilient, and short-term bond fund. Again, if you want to buy fixed income and avoid the interest rate hikes and all that. Yeah.
Great stuff. Thank you, Darius. And
Most welcome.
congratulations to the top 5 people. You guys are really fast. And of course, whatever Darius just shared about the different funds, do pay attention to that. And I'm about to show you how you can actually access that on the Moomoo app. So Darius, we'll be back with you for the live Q&A. See you soon. Okay, so that was the first giveaway. Now I'm going to show you very quickly how you can apply what you learned from the key insights from Darius from Nikko AM. So if you open your app, this is how it should look like. And this is very straightforward. I'm just going to show you how if you're very interested in subscribing to this. Okay, so click on trade, go to Money Plus, and you can see in the right-hand corner so right there, you can see fund houses. Okay, circled in red. Click on that, and it should take you to the list of companies and fund houses available on the Moomoo app. If you scroll down, bottom left corner, you'll see Nikko AM. For the purpose of today, of course, we're going to use Nikko AM. Click on that, and it'll take you to the available funds that we offer on the Moomoo app. So depending on what you want, your risk appetite, and of course, what Darius shared, what you are interested in, you can click on one of it. So for the purpose of today, let's go with the Shenton Global Opportunities Fund. Click on that, and you've got all the fun details in here. Customizable, you can adjust it according to your time horizon. And of course, you've got your own needs. So we have the instruments, we have the tools that will help you make that decision for you. So I think, everyone is looking at different indicators, right? I myself prioritize different things. But if I were to really drill an important key message here, it's to go into the different tabs, right? So it's performance. You've got all the details you need to know. It's live data. It gets updated by the minute as well. So it's really up to you on how often you check. But if you check and see, you'll get the live updates as it goes along. And of course, you got the net asset value. You've got the yields that you'll generate from this. And of course, comments, news, analysis. Now, analysis is where you can get all the fund documents. You can look at the fund managers. You can see what are the components of that, and also the summary components of what the fund entails, in detail. And details are so important when you're about to make a decision. And so we provide that on here, and I hope that you explore it. It's at your fingertips. It's so easy to access on the go. So once you're interested, go down to that shiny orange button in the bottom left-hand corner, subscribe, and you take you to this page where you can use your universal account, and you put in a minimum of 100 Singapore dollars before you click on subscribe. So this is something that is very easy to access at your fingertips on the go. Wherever you are, you can access this. Okay, so I hope that was useful for you. Don't worry, you can still ask your questions. Our teams are on site, and we'll share an email towards the end if you have any further questions related to this. Okay. All right, now I would like to go into the live Q&A because we've got so many questions and we want to make sure that we answer as much as possible. So can I please invite Darius back onto the floor, please? Hi, Darius, welcome back.
Thank you.
Yeah, so we've got a lot of questions for you, but I picked out the top 5, okay? So, yeah, 5 to 6. Let's see how much we can get done within
Sure.
the next 20 minutes or so. Okay, so the first question, someone wants to know about sustainability as a theme. So do you think ESG will be beneficial for technology stocks since innovation is central for sustainability?
Right. So I want to say that, while this is a very big question, but I want to break it down a little bit. So while sustainability has been the talk of town, I think there's a need to really very clearly talk about what this sustainability means. All right. And I want to just harken back to the early days where most of us will remember SRI, socially responsible investing. And that all just means I X out the alcohol, the tobacco, the gaming companies. And then that evolves a little bit to this whole ESG where you're talking about social, economic governance. And I want to say that I think myself, as in Nikko AM, and all of our peers in the fund management industry, we all do some form of ESG. Now, granted, the G has always been the more, strongest part that we were looking at. But if most of us, as in living in Singapore and all that, we will recall the days where we used to have to wear masks, but masks for different reason, and it's really because of the haze, right? So not because of COVID. It was because of all the burning and all these other stuff that used to go on in Indonesia. Now, why am I bringing that story up? Because after the national inquiry that was done by the governments on all this burning and all, a little known fact was the regulators came down to dialogue with a lot of asset owners. And so as a fund management company, they all went, you own all these guys that own all these guys, why were you not questioning how they were doing away with their waste, etc., etc.? And
Sure.
so all these companies, Olivia, had to come up with new ways and not burn. And so they either found ways to recycle their waste, so on and so forth, leading to for some, increased opportunities because they could create other kind of byproducts. For some, obviously, it raised capex issues. They had to now incur greater costs that impact the profitability, blah, blah, blah. And then they had to evolve the business as well. So this comes back to, again, sustainable businesses. But as I've mentioned, all businesses have to evolve and change. So when you're looking at ESG, that has now kind of become a bit of a passé benchmark, if you like, when it comes to sustainable investing. When you're looking at this, what we try to do in our product offering is look at impact. And so impact, I would say, is really the next level of this whole sustainable idea. And by impact, we're not just trying to buy companies that do good. So in fact, we have a double bottom line. We always like to say we have to do good and we have to make money for the clients. There's no point in doing good and losing money because if anyone client wants to do that, they can take their money, donate it to any church, temple, or whatsoever. They would have given that money away and done lots of good, right? So if you want to invest and do good, then you need to know how to put your monies to work into companies which are going to be taking that money and doing good. And if you like, just give two quick examples. We with our fund, we're investing in one telco company. It's a Sri Lankan telco company, but essentially what they do is they employ women to go into rural villages to sell SIM cards. So what they're doing is they're skipping a whole evolution where they need to put telephone lines into those villages. They're jumping onto the 4G, 5G wagon straight away. And so why is this good? Because number one, it's profitable for the telco company. Number two, it gave 100,000 jobs to women. Therefore, there's an impact that's being created, so on and so forth. On the bond side, I'd like to give another example where, you talk about infrastructure, talk about elder care and things like that. These are things that you can't possibly get the equity market to invest and benefit some of all these social causes. Where do you get the money and the capital raising? From the bond market. And therefore, the bonds that you get, you're able to then build the elder care, the student lodging, so on and so forth. So these are very measurable things that also in the long term gives investors a good return for their money. But coming to the tail end of that question, tying in with innovation as well, I would also definitely agree to a great extent. Innovation, a lot of times is used wrongly in the sense from an investment perspective. People think about innovation as what's new, what's sexy, what's fun. We kept repeating this. But yes, I like how this question is phrased. Innovation at the very heart of it is actually meant to solve a problem. And today's green ambitions of the world, there are a lot of problems to solve. Everything from drinking water to the way we use energy and all. And innovation will be really at the heart of all of this. So currently today, there's no way to really get rid of a lot of waste materials in the world today. But who's to say in the next 3 years, 5 years, 10 years, more and more ideas will not spurn out, and we'll kind of like see a development in that front. So I would say that yes, from a technological perspective, definitely don't omit this segment because they are going to be very key front and center with regards to helping us greenify the world. The only thing I would say though is to manage our clients' expectations, because once again, past performance is not indicative of future performance. People who have invested in tech and made double, triple their money, they think that's all tech and innovation is all about, getting that quick returns. But a lot of times when you look at innovation, it could also be in the boring companies. And with that, I want to just use one company that we all actually experience and benefit from, but we don't see, and that is SATS, SATS. Now, a lot of people would know that SATS is the airport services of Changi Airport. What they don't know is that, early days, SATS used to package all your aircraft food by hand. And back then, they were doing something like 20,000 meals a day. But they realized that, hey, we need to upkeep hygiene, we need to upkeep the quality of the food, so on and so forth. And they actually went on a journey to improve their machineries, innovations, so on and so forth. And today's sets can easily package more than 50,000 airplane meals, in a single day. And that is innovation as well. But most people don't see that from a innovation, fun, sexy kind of a way. But this is what I want to say is very, very key to sustainable businesses and sustainable investing. You've got to often look out at how all these different companies are looking at ways to deploy technology and innovation to make themselves more viable. Yeah.
Thank you. The next question is about US and China. So I'm just going to combine these two questions because they are similar.
Yeah.
They're talking about, the relationship with China and also looking at the midterm elections.
Yeah.
So the first question is, do you foresee the US economy decoupling from China next year? And the second one is, what about a warmer or cooler sentiment about the stock market for US-China relations?
I think this is always going to be a very tough question. I would
It is
say,
a question.
I mean,
So
okay,
maybe
I'm gonna,
macro
yeah,
perspective on how the elections perhaps could
sure,
affect and what to look out for
yeah.
next year.
Yeah,
Mm.
so I would say on that note, to be very, very honest, many of the investment professionals within Nikko Asset Management, we don't have a view on that. Most of the time, what happens and what tend to happens is we wait to see who gets in power and what sort of a tone and rhetoric that they are trying to portray. Now, I mean, I say that because not trying to dodge the question, Olivia, but if
Mm.
everyone were to recall about 2 years ago when Biden first got into office, everyone was hailing Biden. Oh, China-US relationship is going to be so much better. And even in Singapore, right, we saw how he came out to the region, so on and so forth. And even in our own Singapore newspapers, we flashed stories about when Biden was back then, just another administrator. He came to Singapore, went to our Newton Hawker Center, drank sugarcane and all these others. And we were like, if this guy comes into power, great. Everything will be back to normal, peaceful relationships. But no, he came in while he didn't have to tackle that hard stance that his predecessor took. He didn't do any better as well. There was no softening. And in fact, now he's seemingly has to kind of pander to everyone else's wish. So I want to just say that, I mean, from a macro perspective, I think the hot seat in the US, which is the presidency, has always been a case where they can say one thing and then they have to play to what the party, what is the talks that
Yeah.
basically wins them the votes, etc., etc.
And the House of
So
Representatives, yeah.
that's right. So if that is going to still hold true in the next few years, then I won't say that things and the tone and all that's going to change. And I say that with all due respect because I feel that they have enjoyed their number one position, as world leader, world policeman, world everything, right, for a very, very long time. Letting go of that leadership position is going to be very, very tough for them. While on the way up, China overtook so many other countries, no one went down kicking, screaming, and shouting as loudly as what the US has done. So, is it going to get better? Probably not in reality. I don't think so. And how is markets going to react? I think markets is always going to react. And it depends whether you're looking at very Western centric kind of news first. And if so, then they're going to always paint China in a very unfavorable light and how the Western stock market is going to be affected that way. But again, if then you see in the next 1 year, 3 years, 5 years, it really depends also how China serves themselves. Will they really play and become the demon that the West is trying to make them become? Or are they just going to say what you like about me, go do your thing, I'm going to do my thing. Here's free trade, here's friendship, here's money, here's working with everybody else. And if they do that, they're going to win a lot more people on the side. And already I feel that the stronger the West pushes this rhetoric, the further they're going to push China into the arms of Russia, India, Saudi Arabia, and all these other Middle Eastern countries. And that is happening, South Africa, so on and so forth. So you could see another very interesting change in world dynamics. And you will look back at this time and say, geez, what if the US had adopted a more friendly approach to China? Would
Mhm.
things have been a lot more different? Yeah, I think that's the key crux.
Something to think about.
So yeah,
Mm.
something to think about. So apologies, no silver lining, no and they live happily ever after kind of a fairy tale ending.
It never is.
Yeah, it never is, and I think it's not gonna be. But again, I mean, really, from more of an investor perspective, let's not forget while the US is big, it's important. China has 1 billion people there. India has another billion, and the rest of the world, we've got a lot more people as well from a demand consumption story kind of a perspective as well. So it is the heralding of a start of probably what's a new change in world order. Yeah.
Thank you. The
Mm,
next question is on Singapore. So we've got two parts of the question. Yeah. So the first part, Singapore blue chips lack the tech stocks. So which Singaporean sector would you recommend as an alternative or a
mm,
supplement to technology equities? And the second part is, we invest a lot in sustainability and digitization.
yeah.
So do you think the two sectors such as ESG, AI, related ETFs are a good space to invest in?
Mm. I'll take the second part first, which is obviously the easier one.
Mhm,
Definitely AI and all these are going to be something that we should look out for, really,
mhm,
because the world is now driven by information. Say what you like, tech is not tech because it's fun and it's, interesting and all that. The likes of the Google, Amazon, and all that, what are they really trading in today? The real commodity that they're trading is information. They know your likes, your dislikes, even Google. I mean, these days, when I get into my car, it will just automatically prompt me 17 minutes to home, right? I'm not going home, but that's what the AI does, right? It recognizes that 8 out of 9 times you're going home and it prompts it to you. So yes, definitely with all the data that's being generated because of the information world that we live in, that's going to be something very key and central. Where I would caution a little bit is more, because that is becoming so key and central, there's going to be an increase in regulatory oversight in that. We're already starting to see it. All these fines, change in regulations, they're all but the start of it. And I think it's for the right reasons. We want our rights protected. We want our privacy and all these other things as well. But yet at the same time, we need to understand that all these people, they're just trying to make money by trying to understand us a little bit better and all. So Singapore companies are no different. They're trying to all latch onto that. I mean, whether you're talking about someone from the extreme of your DBS, UOB, OCBC, trying to use technology, information in the way, and imagine this, right? They probably know us better from our credit card expenditure than we remember that ourselves. They will be able to pull out and say, hey, 20 out of 50 times you spend money at this restaurant, for example, and they could make a whole analysis out of that. And I think that's where Singapore companies are going towards. So while they are not as overt as coming out with or being in the front line of being the likes of Amazon, etc., they definitely are deploying a lot of information technology to gain better intel and as a result be more profitable.
mhm.
So I would say that's where the sustainability comes in. That's where they are generating quality of business and all that. Now, for those that are a little bit slower to the game, those that refuse to spend on technology and improve themselves, then this is where, I mean, the Singapore stock market being small, being very unforgiving, is going to come into play where you either see them get weeded out or they will be taken over by opposition and all these others. So there will be a consolidation in the market. So I think this is a very, very pivotal point for people and businesses to understand that we need to change, we need to evolve. If not, we're better off merging with somebody else and, leveraging on strength. However, to say that, because of the lack of representation, and I think in the last 2, 3 years, definitely we've been bitten very, very badly with the likes of Grab, for example, not even listing in Singapore, heading off to the US, Razer as another example. I mean, it is
Yeah,
unfortunate.
another one.
Yeah, I mean, it's unfortunate we are just 5 million people trading on one Singapore stock market. Um, but that's the reality. I guess when you are trying to be a listed company, you want more people to have access to your stock and shares, greater liquidity, so on and
It's
so
also
forth.
about the volume, no, because
That's right.
there's so much money coming into Singapore.
Yeah.
You got, plus 700 more family office applications. So, there is that potential next
Yes.
year onwards, don't you think?
Definitely there is. I mean, I think say what you like, Singapore has always been rich. So the quantum and the monies and all that is definitely not the issue. But when you're talking about volumes, I think what a lot of all these stocks and shares they would like to see is the volume of trading, right?
Mhm.
And so, especially if you're listed in Singapore, I mean, frankly speaking, other than being relevant in the STI, being relevant in the MSCI Asia Pac Index, we are but a tiny representation in the MSCI world, right? Yes, we're a developed country, but we're less than 0.5 in the MSCI world. So even if you are the biggest boy on the block here in the Singapore market, you're not going to be a point something even in someone's portfolio if they're benchmarking it against the MSCI world. So I think that's the reality we kind of have to face.
Mm,
Fortunately, that's not a challenge I have to overcome. That's SGX's problem, so to speak, how they're going to attract companies and all that. But I
right.
would say that at the end of the day, you could invest into technology in Singapore by one other way, which is through the REITs. Because while it's not very, very obvious, when you generate all of this data and all that, what do you need? You need data centers. And Singapore, we're king of REITs in this region. And so where do you think a lot of the REITs development has been had? And for people who have investing, it's not offices, it's not residential anymore. It's not even commercial logistics. The commercial logistics now, a big part of it has gone into data centers, housing centers. And why? Because for those uninitiated, the profile is very, very different. We setting up a company, we might want to sign a 3-year, 5-year lease at best. But with a lot of these data centers, they're signing 10-year leases because once you set up everything, you really don't want to move your data center anymore because it's a sheer size, volume, upgrading, etc., etc. So that gives a little bit more stability in the portfolio, as well as the fact that it's not going to be something that goes out of business as quickly as, say, a car manufacturer or something like that, who cannot cope with changes in domestic consumption, etc., etc. So that's where I think Singapore has a little bit of play and participation in the tech space. Yeah.
Mm. Thanks for highlighting that,
Yeah.
and also again broadening the perspective. Now we have time for one last question, and I think it's a great question to end off with. So, Darius, which
Mm,
sector do you think most retail investors overlook, but has great potential in the future and maybe needs a longer time frame to mature?
mm,
So, for country-wise, do you recommend that we also invest in new markets and
mm.
rising rock stars like Vietnam?
Yeah, so I would say with regards to countries, there are many countries at play. So definitely your Vietnam, Cambodia, all fall into this idea that I'm gonna move forward. And that is actually Asia Pacific, right? I mean, or even if you want to X Australia out because they are largely just a commodity business. Some people don't fancy them because they're not green anymore.
Mm.
But I would say yes, the Asia region, and that includes all the way down to India and all that and all the emerging countries that you talk about, even Hong Kong, Singapore, Malaysia, Indonesia. This together we do form a very, very big part of businesses as well. And obviously, in the last 3 to 5 years, where it was largely dominated because of internet businesses, COVID related, etc., etc. That's where all these countries we don't really have a big play, in terms of stock markets wise, to benefit from all of that. But coming out of this COVID environment, if we really look hard and ask ourselves, what's going to drive businesses? Is again the very fundamental question of where's the consumption? Where's the income build up? And again, to pull out a story from the old playbooks of old, the US, the European side of things, demographics are shifting. They're becoming more elderly, they're becoming less travelers. I mean, there's still pockets of them that are coming out to travel, but if you look at the sheer numbers, that's falling. I mean, in the past, we could count on even a lot of Japanese tourists and all that. But where are all the tourists today coming from? You look at the new iPhone launch a couple of weeks ago, it's people from Vietnam, Cambodia, all flying down,
Absolutely. Yeah.
buying the phones because they want to go back and sell it there. you
Mm,
know so I
yeah.
think the affluency of all of these neighborhood not neighborhood, sorry,
Indonesia as well.
neighboring country, exactly, yeah. So I think this is something that has been overlooked just because everyone has focused on crypto, has focused on tech growth in the last 3 to 5 years, that Asia kind of looks a bit boring, and the only Asian thing that they would consider was China because of Tencent, Baba, and all these others. But if you really go back now and say, okay, use this fall in the last 1 odd year, in the stock market as kind of a reset button. And if we really take a logical step back and ask ourselves, so if I'm going by fundamentals, where are the places that will have the businesses to drive it, have the earning power, have the employment rates, etc., to support that, and the education system to make sure their people are getting more and more educated better jobs, etc., etc. And one will have to come back again to the conclusion that they have missed out on Asia, So
Mm,
it will not be a quick recovery again, simply because Asia is so diversified and all that. But I already start to see pockets of, recent government, conversations where they're trying to band ASEAN together again, and so on
mm,
and so forth, and
mm.
then use this, block to work closely with China and all these others.
Right.
And
Yeah.
potentially this could become, I mean, if you put all of this together, frankly, we should be, the biggest block of economic activities, even outside of the US, Europe, so on and so forth as well. So I think if there's anything, I would say explore Asia again. And this is not just to talk about equity market, because the fixed income market is also expanding quite a fair bit. Gone are the days where, you face the fixed income market where, once you got a strengthening US dollar, everything else gets thrown out with the bathwater. I think even Asian fixed income, they're starting to stand on its own. Already, I pointed out earlier on, not every country is bucking the US trend of increasing interest rates. Some are actually cutting interest rates to attract investors, back into their countries. Some have even decoupled their currencies. So again, you're not going to face a situation where strengthening US dollar wipes out everyone, but you're going to see, countries standing alone on their strength of their currency value. Yeah.
Mhm.
Mm,
Thank you, Darius, for answering all the audience questions. We've got a
mm,
lot more, but that's all we have for time today. And
yeah.
thank you for covering so many different perspectives and different fronts. So with that, Darius, just stay on the line. We're going to go for our last giveaway to everyone watching. And
Thank
thank you
you.
to the audience once again. We're rewarding you for being with us and also being a part of the discussion with Darius on the
Mm,
line. So the question 2, for those who just joined and missed the first quiz, first 5 fastest fingers, and you have to get it right. You'll stand a chance to win something from our teams. Are you
mm.
ready? Question 2 in 3, 2, 1. The Federal Reserve has raised interest rates 5 times in 2022. True or false? Straightforward. I'm sure you
Everyone's
guys will get this.
everyone's counting right now, like,
Count correctly, guys.
yeah. Actually,
All
this is
right.
this is an interesting one because they might do one more, right? But
Yeah,
oops,
that's true.
hopefully I'm not confusing anyone.
Okay, we got our 5 winners. Congratulations. Now, Darius, what is the right answer?
I believe the answer is false.
All right. Now,
Yeah,
what is the right answer for this?
this answer should be 6 by our
Yeah.
count. Yes.
All right. So those of you who answered this correctly, congratulations. The teams will be in touch. Now, Darius, to end
Mm.
up our live show for today and also for everyone out there, what is that summary point or one final key takeaway for them before we end the
All
show?
right. So I would like to just say that, having said so much and all that, I think one of the things, and I mean, this is also just to show our support back to Momo and all that. I think, with all the information that's available, the platform that's available and all that, investing really should be a habit. All right. So I'm not sure if,
I love it.
right? Okay. Yeah, it
Yeah.
should be a habit, right? Because you're not just here because of the here and now. But why a habit is because, if a habit is something that even if you forget it, right, you're still left with a
A
bit.
bit.
Yeah, there you go. And then at the end of the day, you still have the bit with you.
A bit
And
with you.
at the end of the day, yeah, you still have it. All right.
It.
So yeah,
Oh,
there you go. So and the amazing thing about habits is this, and again, all the things that we've said, frankly speaking, it's not like it's happening for the first time ever. It's
right.
been just markets going over and over again. But if you look at quality, if you look at sustainable, the day will come that you forget that you even have done any of this. But the thing about habits is this, it always has an interesting way of coming back.
What?
So with that, I hope this has been a useful session for all of you. Please invest as a habit, not as a form of speculation and gambling. And
Yes.
hopefully 2023 will be a great year for your investment returns as well.
Wow,
Yeah.
thank you for ending off with that. Very comprehensive. Thank you so much for sharing your key insights. And of course, that final message you
Mm.
got there. And I still don't know how you did that magic right there. I'll still be thinking about it after the show. But thank you. Darius Fu,
Most
everyone,
welcome.
Head of Intermediary Business Development from Nikko Asset Management. Thank you, Darius, for joining us today. And we
Thank
look
you for
forward to
having
the
me.
next show we're going to
Yeah.
have together.
Yes, thank you for having me.
Thank you,
Bye-bye.
Darius. So to those watching, I hope you enjoyed that. And if you enjoyed shows like these, remember to stay up to date with the social channels, with the app as well. But of course, I promised you the email. So this is the email. If you are interested in finding out more about your questions, and also if you have further inquiries for the team, you can email us right here. So for the teams, could I please have the email to show the audience? Yes, so right here. All right, so drop your questions here and also in the chat box right now. But if we don't have time, of course, you can definitely drop us any note and we'll be right back with you with any of our answers. Okay, so here's the QR code if you want to scan it for more shows like these. We've got our final shows tomorrow. Scan the QR code right here and follow us for more information. We'll also update with key sound bites from Darius today and key information that you'll need to know. So do be sure to follow the pages to stay up to date. Now, the next page for our social channels, that's where all the activity is happening. And any, if we're on the streets in Singapore, wherever we are with our mascot and also our fun edutainment content, you can tune in for more information here. Scan the QR code if you want to find some click-throughs, just whenever we go live, that's where you'll find the first information. So follow our IG channels, our Telegram, our YouTube, and of course, all the content is crafted just for you. And so we want you to be in the know with everything. So I'll see you on our social channels. I'm not going to share what we have around the corner for December. You'll have to follow to find out. And of course, with the World Cup happening right now, very exciting. We're also helping you with inflationary measures in the rising rates environment. So, we've come up with this campaign to help you with that. So if you're interested to find out more, you can also stay tuned to our channels to see what else you can gain from the campaigns that we have out there. But yeah, the World Cup is exciting. And so check out this campaign for more details. Okay, so the next show we're happening tomorrow and we're covering the Asia story. What is different this time around is always about checking in and seeing what else 2023 has in store for us. So we'll see you for the next show. Once again, thank you so much for joining us today. And I'll see you tomorrow for another round of insights from our experts. Once again, I'm Olivia Higgins. See you tomorrow.